This wasn't supposed to happen. I'm your host, Steve Van Metre, and thanks for joining me today. Central elites are flip-flopping as a painful outcome. Looms. Let's over to Wall Street Journal, where we picked today's story up with the headline, "Reducing inflation without a recession might not be feasible," Fed official says. Now, I want to go back to what the original narrative here with the Fed was, is that we had a problem where demand was greater than supply. And all they wanted to do was just tap on the monetary brakes a bit, slow the economy down, and let supply catch up with demand. Now, remember, we were just supposed to slow the economy down. Nothing bad was going to happen because as the economy reopened, what were we supposed to see? The supply side start to increase, and now all of a sudden we're seeing them completely flip-flop on their view and start to tell us that something bad is coming. I'm looking at a labor market that is so tight, I don't know how you continue to bring this level of inflation down without having some kind of real slowing. And maybe we even have a contraction in the economy to get there, according to Kansas City Fed President Esther George, who is set to retire, will say good timing in January. So all of a sudden, you get this flip-flop in views that, hey, wait a minute, maybe we're actually going to have a recession here, when really our only plan was to slow the economy down just long enough, let supply catch up to demand, and then take the brakes back off. And all of a sudden now, perhaps a different outcome is coming. I would love if there was that path. I've seen people paint the path, she said. I've not in my 40 years with the Fed seen a time of this kind of tightening that you didn't get some painful outcome. So this doesn't make any sense at all. If they know that rapid rate increases lead to a bad outcome, then why did they do it in the first place? And so it starts to make sense that they have no clue what they're doing, and that's why they're pivoting. That's why you're seeing them flip-flop, because they want to get on record now saying, look, hey, we said this was going to end in a recession all along, because now that's becoming the base case. Seeing that we're not going to get help on the supply side, we have a lot of work to do. When I think about inflation today, we've kind of turned that tide of supply chain production side shortages. Now we're looking at the labor as a driver here. So again, we see where they're going here. They say, well, look, we were trying to fix the supply problem by slowing down demand a bit, but it turns out the labor market threw us for a loop. That's not our problem. We're supposed to keep the economy at full employment. That's what Congress tells us to do. And we did it. So see, this bad outcome that's going to happen wasn't our fault. But we want to look now and see, are the Fed's decisions to raise rates affecting supply in a positive way or a negative way? Well, we already know the answer, and it's not pretty. Homebuilder sentiment dropped to a decade low as builders add more incentives. A monthly sentiment index from the National Association of Home Builders dropped 5 points from October to 33. Now, that's the 11th straight monthly decline and the lowest since June of 2012, with the exception of a very brief drop at the start of COVID-19. A year ago, builder sentiment stood at 83, and not too many months ago, we heard just builders saying that they were really enthusiastic, they were really optimistic, they believed if they build it, buyers would come. Well, perhaps that's not happening. Looking at this chart from Zero Hedge, we see home builder confidence tanking, and as we pointed out in the past, that home buyer confidence leads home builder confidence, and while they remain very optimistic, home buyers said, no way we're paying these prices and at these interest rates, and that's starting to turn into a slowing economy. In November, 25% of builders reported paying points for buyers. If you don't know what that means, it means they're buying down the interest rate on the mortgage, up from 13% in September. Mortgage rate buydowns rose to 27% from 19% during the same time. In addition, 30% of builders cut prices in November, up from 26% in September, with the average price reduction of 6%. However, the price cuts are only about half of what builders offered in 2008 during the housing crash and the Great Recession. So all of a sudden, the supply imbalance that the Fed was supposed to fix by slowing down the economy is now leading to the opposite effect, where builders actually overbuilt and are now starting to cut prices, and that's going to lead to a reduction in future demand. It's also going to lead to higher unemployment. As you can see with today's data, it's showing exactly that's happening, and builders are starting to get the message. As U.S. housing starts to drop with a pullback in single-family projects, New home building declined 4.2% last month. And residential starts declined again 4.2% to 1.43 million annualized rate after an upward revision to the prior month, according to data released today. Single family home building dropped to an annualized 855,000 rate, the lowest since May of 2020. And applications to build a proxy for future construction fell to an annualized 1.53 million units. Permits for construction of one-family homes also dropped to the lowest level since the early months of the pandemic. Now, this is not what the Fed wanted to hear. I mean, you think about, they're trying to slow demand down. They slowed demand down so much that it's now bringing supply down in a way we didn't expect. And we can now see the future of the housing market, which is important to follow because it's 20% of the U.S. economy. So when you see the housing market to slow down, it's going to have broad-reaching effects into the rest of the economy. And we can see in this chart, also provided by Zero Hedge, that when we note that housing starts follow building permits. So we can see building permits here in blue heading lower. Housing starts appears to be at the moment leading, but really you can't build a home unless you have a permit. So as permits start to go down, we can expect housing starts to follow. And check this out, the National Association of Home Builders now has acknowledged that future sales are coming down. What a shock. And that means housing starts are going to follow, again, leading to higher unemployment. You think about all the people involved in building a home, not to mention the people involved in selling a home, the people in financing the home. It's going to have a major impact on the economy from a supply side. This isn't what the Fed wanted. Now you see why they've got to get this flip-flop on the books, because they have to get everyone to believe it wasn't their fault. And it's not just the housing market we're seeing have problems, it's also the manufacturing sector. As U.S. industrial production unexpectedly contracts in October as capacity utilization slows. U.S. industrial production unexpectedly fell 0.1% in October, the biggest drop since December 2021, and less than the expected 0.1% increase. Additionally, September's 0.4% month-over-month rise was revised drastically lower, just down to 0.1%. That is the fourth monthly decline in the last 6 months and the slowest year-over-year rise since January. Again, if you're trying to fix a supply and demand imbalance, what you want to hear now is that manufacturing sector is growing to meet all this increased demand, which the Fed is just temporarily slowing down. Now we're seeing, again, the opposite effect. Supply is falling because demand is falling faster. That's not what the Fed wanted, and that's why they're starting to say a recession is coming. And here we can see on this chart that industrial production is largely just a function of the stock market. Of course, with that being a proxy for the U.S. economy, we have here the Wilshire 5000 price index, the total U.S. stock market, and industrial production. That one in blue, both on a year-over-year rate of change. And notably, we can see the stock market leads industrial production down. Now, even if we were to get a big bear market bounce or a melt up, as long as industrial production continues to fall, it tells us that any increase in the equity market is not being passed through to consumers, and that's what really matters here. Is demand is falling fast, and that then turns into a decline in inflation, as we can see from this next chart in capacity utilization. Now, capacity utilization shown in blue, this is a percentage of a factory's capacity that is being used. So when you get over 80%, which is right about where we're at now, you start to get inflationary pressures as factory owners start to increase their prices. But inflation will dissipate as capacity utilization falls back down and heads towards 75. So we note that it looks like it's peaking here and potentially heading lower, and that lines up nicely with actually the CPI index here peaking. But of course, that then now leads to the question is, where is future demand here? What are these factory surveys starting to tell us about where the economy is headed? And before we take a look at that, let's hear a message from today's show sponsor. It's been a rough year for investors, as most of them have bought at the top of the market and are now selling as stocks appear to be bottoming. It's gotten so bad, JP Morgan now reports the average retail investor is down 44%. The 60/40 portfolio hasn't fared much better, down 34% on average, according to Bank of America. With volatility still raging, institutions and retail investors alike are looking more to alternative investment. Financial Times says institutions are already maxed out at 30 to 50%. But one fund manager was quoted as saying, "It's a race for everyone else." Now, institutions are helping investors get into a variety of alternatives, including fine art. I know, it's surprising to hear fine art, but Goldman recently named fine art among the ways to help protect your purchasing power. And pieces sold for an average of 26% more at auction during the first half of this year per Morgan Stanley. Masterworks lets you invest in similar multi-million-dollar art for a fraction of the full price. Their last 3 sales have resulted in 17, 21, and 33% net internal rate of return to their investors. Masterworks has had 5 exits so far this year, and paintings have sold out in minutes. But you can get priority access to Masterworks by clicking my link in the description. Now let's take a look at the Empire State Manufacturing Survey, giving us a leading indication of where things are going. Now the headline looked pretty good as business activity edged slightly higher in the New York State, according to firms responding to the November 2022. So again, this is early November survey. The headline General Business Conditions Index climbed 14 points to 44.5, but check this out, new orders decreased slightly while shipments expanded modestly. Delivery times were a little changed and inventories grew significantly. So you don't really want to see inventories rising in the manufacturing base because that suggests that demand is falling there too. Labor market indicators pointed to a solid increase in employment and a longer average work week, while input prices increased at the same pace as last month, while selling prices increases picked up. Looking ahead though, here's the key point. Firms expect business conditions to worsen over the next 6 months. Now, what we can take away from this is from an employment perspective, the manufacturing base is holding on. They're still seeing some demand, but they're slowing now. Now, let's look at what they had to say about the future, because that's the key of where the economy is headed. Firms are pessimistic about future conditions as future business conditions fell minus 6.1, indicating net firms expect conditions to worsen over the next 6 months. And that means new orders and shipments also in the future fell into negative territory, although employment is expected to continue to increase as modest increases in capital spending and technology spending are planned for the months ahead. So what you're hearing from the manufacturers are, look, we're concerned about a labor shortage, so we're going to keep or try to keep the people we have, but demand is going down. So when you start to hear new orders fall and you start to hear things like that, that means, of course, unemployment should actually head higher, but in the interim, it means consumer price inflation is going to slow down. Now let's take a look at the Philly Fed, who echoes a lot of that sentiment. As manufacturing activity in the region continued to decline, a big drop according to firms responding to the, again, November survey between 7th and the 14th. The general activity index declined further, and here, get this, new orders index remained negative, so continuing to contract. The shipments index remained positive but low. The employment index declined but continued to suggest overall hiring. So again, you see that manufacturers are trying to hold on to employees here, and the price indexes continued to suggest overall increases. Although the survey's future indices rose slightly, they continue to suggest that firms expect, get this, overall declines in activity and new orders in the next 6 months. And you can see future activity and current activity heading lower here. And again, this is that red flag for the Fed that's got to pivot now to recession because they went too far and they don't want to admit it. Let's look a little deeper into this report. Because what do we see? New orders contracting again for the second month. Not something you want to see. How about unfilled orders? There's your inflation backlog. That's contracting again for the next second month in a row. How about delivery times? They're continuing to contract, meaning they're getting faster, meaning deliveries are happening at an increasing pace. Prices paid slowing a little bit, number of employees slowing. So all things are adding up here to what doesn't make any sense when we see Fed's Buller get out today and says more rate hikes are needed to get to restrictive levels. Perhaps someone who is completely clueless about what's going on in the economy. And even under these generous assumptions, the policy rate is not yet in a zone that may be considered sufficiently restrictive. To attain a sufficiently restrictive level, the policy rate will need to be increased further. It's possible that the increased financial stress could develop, he says, but however, the transparency with which these policy rate increases have been delivered, which he's referring to is their press conferences, when they get out and tell people, look, we're going to raise rates and keep raising rates. So he's saying, look, we've been telling you rates are going higher, so there shouldn't be a problem. There should be nothing that goes wrong in the system, but we know that's not how it ends. Seems to have allowed for a relatively orderly transition to a higher level of interest rates so far. He goes on to say that the St. Louis Fed's financial stress index is so far indicating a relatively low level of financial stress. Despite the sharp increase of rates this year, perhaps what Bullard is missing here is the fact that we're going to actually see the lag in monetary policy hit all of this into next year, and you'll see them completely flip-flop on that and cut rates. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.